Hello and welcome to this week's instalment of Nucleus Investment Insights. As the world is tiptoeing its way out of the coronavirus pandemic, the consequent surge in the price of energy, metals and crops is highlighting the strengths of some economies and the vulnerabilities of others. Rising commodity prices have strategists asking if resurgent demand for raw materials and insufficient supply will create a new commodities supercycle. Whilst pricing swings, of course, are as old as business itself, a commodity supercycle is different, however. In the usual business cycle, demand pushes prices up and supply increases to try to capture that windfall, sending prices down again. In a supercycle, supply is so inadequate to demand growth that prices rise for years and years, or perhaps even a decade or more. Supercycles are not a new thing. In the 1970s, spiking oil prices created a boom that lasted into the early 1980s. In the early 2000s, China's demand for steel, aluminium, coal and copper kept prices high through 2014, with a spike thanks to record high oil prices in 2008. External shocks are a prevalent issue, and so now the question remains, can this corona-based commodities supercycle raise the spectre of more damaging inflation down the line, and how likely is the current boom to continue? So joining us today to share his thoughts on the state and the future of commodities is our Chief Strategist here at Nucleus Wealth, David Llewellyn-Smith. Hello to you, David.
G'day, Tim.
And joining across the table today, we also have our Nucleus Wealth Head of Investments, Damien Klassen. Hello to you, Damien.
Hi, Tim.
Fantastic. And just a quick reminder that before we get started, if you haven't already, to subscribe and click on the notification bell to be notified of when we go live or have a new webinar to watch, or follow us on your preferred podcast platform. We also ask if you'd like to take a moment to click like on the video now to help our show grow. And for those listening in live, feel free to drop in your questions in the YouTube live stream chat to have them answered along the way. So we'll jump into our agenda for today. So today we will be looking at, kicking off with demand, moving across to supply, looking at some cost curves of commodities and financial flows, and then wrapping it up, as we always do, looking at our investment outlook and how we use these themes here at Nucleus Wealth in our portfolios. So with no further ado, we can jump into it, and we might kick off with what is a cycle.
Yeah, sure. And so we're going with some extra video today, but we just got it the wrong way around at the moment. So you might want to flick our charts.
Certainly.
We'll get.
There we go.
Yeah. So I just wanted to I guess ruin the surprise and sort of start with the conclusion, which is, look, we don't think we're in a super cycle, but we do think we're in a cycle. And I just wanted to talk about a normal cycle first, before we get into what is a super cycle. So, you go through this part, and I'll start on the right-hand side. You get you get high prices in a particular commodity. You get all this new supply comes on, all this production increases, supply gets greater than demand, and in commodities, supply is generally quite fixed. It's not very reactionary, especially in more and more now as mines are getting bigger and bigger in a lot of commodities. So for a commodity like gold, for example, it's not as much. You still get a lot of small mines, but in most of the bigger commodities, say copper or iron ore or ones like that, it's actually more about a few really big mines producing most of the commodity, and the small ones really just fill the gaps. And so you get a new big one come on, and it just sort of swamps your supply. Prices then fall. Higher cost mines start to close at the bottom. You don't get any new mines built till you get this sort of equalization, and then you start going up the other end as you demand, sort of which is pretty steady usually in most commodities, just gradually grows over that time, and then you're back into this part. And as the prices go up again, usually if it's been a long enough cycle, which it usually is, miners don't actually rush out and build new mines because they're like, well, yeah, prices are high, but prices have been low for a long time, and so we don't want to go out and build new mines until we actually can see that the price is going to be high for a long time, and then eventually they get round to it, and then there's a big delay while the mines actually get built. The prices spike even higher, and then back to the start again.
That's a classic inelastic supply curve.
Yes, absolutely, and with a big delay. You know, because most mines will take a number of years to come online. They'll probably be. It's not really a matter of going out and discovering these minerals. You know, although that is going on at all times. Most of the ones they're already discovered. They've done a feasibility study. They know what they need to do. They know roughly the volumes, and they're just waiting for prices to be high enough that then they go, yeah, okay, today's the day we're going to pick over. So that's a normal cycle. You get these super cycles, and as you spoke about last time, as Tim spoke about in the intro, you know, when you get some big shocks, say a supply shock to oil, where you know some of the biggest producers in the world suddenly say we're just not going to produce the supply anymore, and that sort of shoots it up. Okay. We've got another chart showing here, which is the real issue was China. And so what we've got here is a whole range of different commodities, and just showing the demand that came from China over that sort of 2000 through to 2015 period, where China went from, so looking at iron ore there, you know, of 30-40% of world demand to well over 50% in a number of cases, and that was the real issue. That's really what you really need for a super cycle is either a big change in supply that you weren't expecting and to reduce and take away supply as per the OPEC cuts in the 70s, or you need some new massive source of demand that wasn't there otherwise and grows. And that for the sort of 2012 or 2000s, early 2000s super cycle was China, the rise of China, which really drove that and drove prices to high levels. Okay, so that's sort of a bit of a background about what is a super cycle. The next most important thing is looking at prices and the long-term prices in them. And so we're going to go through those in a bit more detail as to where the structures are. But we're going to pick on iron ore and copper as two of the biggest metals. And so we've got a slide up there showing now, which is the about to come up, which is the long-term prices for iron ore. And so and this is all put in real dollars, in real today's dollars. So it's a comparable number sort of going back. And I've tied together two series. One is the iron ore price, which has really only been around for sort of 20 odd years in terms of less than 20 years, in 10 or so years in terms of market pricing. And then back in time, there was contract pricing, and I've used the global prices and then merging back into the US to sort of go back for 100 years. And you can sort of see that it's much lower. Yep. Is that price? We're in our sort of third big super cycle. So we had a super cycle which sort of brought iron ore prices up to sort of $70 odd in the 70s. Then you had and
on that occasion, that was the introduction of Japanese demand to the global economy.
Yes,
as well as some Korean. So that was. In terms of what you're describing as what you need for a super cycle, that was again a structural change to demand that caught supply short.
Yes.
So that was a super cycle.
And so we peaked out at iron ore prices of $70 in today's iron ore terms of $70. Okay. So while it was a super cycle, a $70 price today would seem like quite a cheap iron ore price. And then we went into this massive cycle that sort of hit, over $200 a ton as that China demand really kicked in, and then back down to sort of $50, and then and all that took was wasn't even a fall in iron ore demand. It was actually just a flattening in iron ore demand because of all the new production that was coming on from miners, and now we're off again and running, and so. And a lot of this latest spike has been a mixture of there's certainly some demand strength in terms of new construction in China, but there's also a big element of it is supply weakness in terms of mines either brought off online in Brazil because of various ups that's happened there, which actually taken large swathes of the production out, or coronavirus type issues in terms of supply constraints because of coronavirus. So, for example, South Africa cut its production back quite significantly because there was limits on how many people could be in the they could have mining. Yep. And so there's those types of things which have all sort of been And so that coronavirus type stuff doesn't jump out and say, okay, this is a structural change which is going to be, we'll never again be able to have this number of workers working on mines.
Mm. So it's not. Yeah, so it's not like it's not like China in the 2000s. Essentially, a billion plus populations just suddenly launched into a demand sort of driven stage.
No,
So
and in terms of what Damo said before, referring to just a normal cycle for commodities, where you had lots of supply that crashed the price, and then you have a period of the high cost mines exiting the market.
Mm-hmm.
That's what you can see in that chart as well. Even though it was a super cycle that delivered the supply, we've then had a period where prices were low, and so a lot of high cost production left the market. Then you had the supply shock with Vale. And this is important because we now have super cycle prices, but the question is, are they sustainable? Because that demand supply gap is also sustainable, but all of those mines, and we'll get back to this, that go up the cost curve to more expensive, they're all brownfield developments that are just shuttered.
Yep.
They haven't gone away. And so with prices where they are, they're already reopening. There's heaps of them all over the world. And so you're already getting a supply response that was in place for the super cycle, the prior super cycle, then got shut down by the big wave of new supply, and now can just open up relatively easily. Yeah. So, and then you add that with Vale coming back as well, of course, which was actually a more severe supply side shock.
Yep. Okay.
There's those various factors coming in, and it means essentially iron ore is not going to be in a super cycle.
Okay.
Copper is the other big one we wanted to bring up as well. So same type of chart for copper. Again, this is on a per ton basis. Over $8,000 a ton, you're in a super cycle in copper. Yep. And we're well over that. At the moment, you can sort of see basically the same type of factor. There is a question mark about is there a super cycle coming because of electric vehicles, and we'll go in a little bit into terms of that. So it's certainly a question that's well worth asking in terms of is the amount of copper we're going to need suddenly going to spike higher, and so we'll raise that. We'll come back to that. But I guess the idea is, again, there's over the last 100 or so years, there's sort of been 3 or 4 times that copper has been as high as what it's been today, and so you've already got super cycle prices. Now you've got to work out whether they're justified, or is it just the fact that there was a short period of demand where demand dropped out. Where supply
dropped out.
Yeah, supply dropped out, and demand
jumped in,
and so now it's just a matter of waiting for these mines to get going again.
Just on that, obviously, so we're talking about like real demand here. What about synthetic demand? So what about financialization, where people go, okay, well, I'm just going to go and buy a truckload of futures contracts, and I'm never going to build anything. I'm just going to trade it out to the next government who wants to build a bridge.
Well, we've got a segment on that later.
Okay.
Maybe we should leave it until then.
Okay, sure.
Yeah.
Yep. No problems. We want to jump across to demand? Happy with copper?
So just wanted to talk through some iron ore. So we spoke about China on the iron ore front, and just wanted to sort of show how stark and I've got steel production, which is sort of similar to the amount of iron ore used in China, but it's sort of not quite the same, but it's probably more direct in terms of what's the iron ore is going in there because they want to make the steel, because they want to make buildings largely. Okay. And so you can see that's just China has gone from basically almost nothing to the biggest, greater than the rest of the world put together in terms of the steel production. And then you say, well, where are they actually using it? And you sort of go back to the next one, and more than 50% of it is going into construction. And then if you dig into that construction even further, the bulk of it goes into buildings. So roads don't use that much. Bridges use a bit, but a bridge versus a high rise, it's actually relatively similar, and there's a lot more high rises going up than bridges.
Bridges, yep.
Okay. And then
subways use a bit.
some ways is a bit, but
rail a bit.
Yeah, but not as on a per kilometre basis. It's not as much as you think. It seems like I can see iron ore. I can see the steel, the train tracks going forever. But when you compare that to the amount of steel in a building, the amount of steel in a building actually is actually comparable. You don't need too many buildings to offset a lot of rail.
That's a fair point. Yep.
So so the real question is, in terms of China, is how much construction? What's construction doing in China? That's the real swing factor, because construction in China, there's a lot of stuff been about empty apartments and all that type of stuff. China spoke about having an unbalanced economy, and they needed to diversify away to it back in 2007. Now they're building 2 or 3 times as much as what they were building back then. So it's just like this. There's this huge building apartments that just keeps on going, and China's population isn't growing, so it's an urbanisation story. It's basically people moving from the country into the city. There's still plenty of scope for urbanisation, but I'll jump to Dave's chart. Actually, I should let you go through some of this stuff.
Well, maybe we'll flip over
The next,
a couple, and we might get to.
I was going to do.
Go one more.
Okay.
Oh no, hang on. What happened to the list of demand stuff? Did we pull that out?
Yeah.
Okay. So this is the key chart in terms of urbanisation, which is the driver of both the apartments surge that Damo's describing, as well as infrastructure, and as you can see, in the decade up to, I wish I had my glasses on because I can't see, but it'll be up to 2010. The absolute number of people that China was able to urbanise actually peaked. Even though there's still some scope, they're currently at about 61% urbanisation. I think most Western countries are about 80. Is that right? 75, 80.
Yep.
And so it's very likely to continue. But basically, in absolute terms, the number of people that you're shifting is starting to diminish.
Yep. Okay.
Year on year.
So it sort of peaked over 25 million people a year moving into cities, and now it's back in the sort of lower 20s.
Yeah. So what it means is you need to build less, and we've already seen that to the decade of 2020, and the decade to 2030, it's another step down. Now, these are very big numbers with a lot of variables, but so I wouldn't bet my life on the precise numbers on this, but in trend terms, they're basically right. So the other factor that you've got to consider with this is that a lot of the building that goes into the urbanisation is done in advance. So as you mentioned earlier,
except maybe in Australia, where
well, yes,
the suburbs get built long before the infrastructure.
You need to be able to look beyond the next electoral cycle.
Yeah, that's right.
Which is one benefit of central planning. So, I mean, I think Damo mentioned earlier actually that there are 70 million odd empty apartments in China. So that's obviously, built in advance of moving more people into these cities. Like you can call them ghost cities or whatever you like, but they're actually just pre-builds, right, for what is going to be an ongoing urbanisation plan. So that obviously means as you're moving less people and you've already got a lot of the supply in place, then the demand drop-off could actually end up being quite precipitous. And so this is the number one kind of fundamental demand headwind for any notion of a new commodity supercycle, is that China is slowly but surely going through this structural rebalancing of its economy. It's had a little bit of success on it, but as Damo said, so far it's also talked a lot and done the complete opposite, because what it also involves in this transition is much slower growth. And so, the question becomes a political economy one of how much slower growth can a Chinese Communist Party that has based its legitimacy on growth handle slower growth. And so far, that's played out in what is a kind of steady flight path downward rather than a crash. In in these drivers of commodities. I expect that will more or less continue, and the lever that China pulls every time growth gets too slow is a little bit more stimulus. Quite often it's more credit for households to buy more apartments, or more recently there's been more infrastructure involved. But on both fronts, the problems are mounting. For infrastructure, excuse me, is very built out, and so the more credit charged infrastructure you put in, you're actually creating a long-term headwind for your productivity and growth by just accumulating a huge debt pile that won't get a productivity dividend. And private debt is actually surprisingly high in China already in households. It's comparable with the US on income basis. And of course, corporate debt in China's just insane, like completely off any sensible scale. So they've got these debt problems and they need to transition away from them, as well as running out of some of this urbanisation. So I expect they'll just manage their way down through this over the next 10 years. But it means you're effectively taking out a huge slice of demand across a whole bunch of critical metals.
Yeah,
Yep.
Actually, that chart we put it at the start of the chart we moved.
Okay.
That
Yep.
was the one you wanted with showing you all the rising command.
Oh yes, well yeah, that's a useful one. So metals and energy as well, because China is also going through the thin end of the wedge on a big greening process, and so if you not only do you need to find some new source of structural demand to argue for a super cycle, it's got to be big enough to offset the decline in Chinese demand, the largest demand shock in the history of the world. And so it actually sort of becomes preposterous when you think about it in big number terms. Where these things have all come to bear in recent times is we've just had the latest 5-year plan at the 14th what do they call it? Plenary, bloody hell, I can never remember what they're called. But it's the latest 5-year plan out to 2025, and no matter where you look in the plan, there's less infrastructure, less airports, less rail, less of everything. And real estate in particular is being targeted as something that the Communist Party would like to see, as they put it, houses are for living in, not speculating on. And there are a whole range of new policies that are targeting big developers in particular to try and deleverage them. There's a thing called the three red lines policy that mandatorily limits leverage in the big developers. So there's a whole bunch of new measures in the next 5-year plan that will steadily suck away demand for construction, or will suck away construction. Now, I'm not saying it's going to be a cliff. I don't know, but I think it's in trend terms pretty certain.
And it's worth noting as well that so we are speaking about iron ore, but copper and a whole bunch of other metals go into that same bit. So in the average apartment, got the figures later, but it's sort of 100 to 200 kilos of copper goes in. So it's actually quite a bit of...
it's very relevant to copper as well.
Yeah, and the other thing is that we haven't spoken about a lot is recycling.
Yep.
So China doesn't recycle very much at all, and some of that is because... when you knock down a hut in a village somewhere and you move somebody into an apartment, there wasn't any steel in the hut, so you don't actually get, you need fresh steel for it. But as you get to the stage where you're starting to knock down apartments, that's where there's a lot of recycling from the steel, and cars as well. So and steel and copper, both those, cars and construction, you get a lot of recycling from those. So as time goes on, not only will they need less, but they'll also be recycling buildings and cars and things like that. And so the actual net amount of fresh copper or fresh iron ore is going to be even lower again.
Yeah, sure. Okay.
I haven't provided the chart on steel. It's a very good example of it, but China's roughly recycling 20% of its steel output. today. The US is 70 or 80%.
Wow. Yep.
Most developed economies are very high.
Mm-hmm.
There are a few exceptions. Japan's still quite low. But there's a trend up in the scrap proportion of steel output that's very solid and will continue. And we can see this at the policy level as well, with China recently reversed its 2017 decision to ban steel scrap imports, probably given extra impetus by having the shits with Australia. But you know, we're definitely going to see steel scrap, but other scraps, copper scrap as well, become just trend higher as a proportion of Chinese. So
Yes.
even as its fundamental demand diminishes, we'll have an entirely new source of supply that is non-mining.
Yeah, sure. Well, just finally though, and I just wanted to touch on, I guess, and this is probably short term, isn't it? But you know, they've got this sort of post-corona government, you know, hammering for deficits, spending money wherever they can, driving infrastructure, driving, you know, is that? And I'm just sort of excluding China, perhaps, and looking at the rest of the world. Is there an ability for the rest of the world to actually soak up some of the?
No, absolutely, it'll soak some up. I mean, just the rebound in steel output that was damaged by COVID, so you know, blast furnace suspensions worldwide, that's going to add 20 or 30 million tonnes to iron ore demand over the next 12 months. But that'll just get us back to where we started. So that's answering the second part of your question first, I guess.
Yep.
And then secondly, yes, we're going to see, excuse me, especially in the US, significant infrastructure investment, as there should be. However, and there's a little bit in the UK, in Europe, but it's not really worldwide for starters.
Well, and the other thing is, if it's a matter of saying, okay, we're going to build a lot more roads, but we're going to build a lot less high-rise, and we're going to build more houses because nobody wants to live in high-rise anymore, and companies don't want to build more commercial space because they're all getting people to work from home or working, you know, using up less office space.
Well, there might be a super cycle in lumber.
Yeah, exactly. So that there's quite possibly some offsets. Like, we haven't spoken about the downside. We're just talking about the upside on this,
sure.
but there's quite possibly some offsets which might be quite significant as well.
I mean, Morgan Stanley had a look at the Biden infrastructure package in terms of its impacts on commodities. You know, they mooted $3 trillion, more or less. $2 trillion of that is actually human infrastructure.
Right.
For starters.
Yep.
So a lot of that's IT and training, investing in education and what have you. There'll be some building in that, but a lot of that is just human development. But even the other $1 trillion or so, it was, if you start looking at the roads and bridges and rail and what have you, at least for steel, it was relatively minor. Like, it added, you know, maybe 10 million tonnes. 7 to 10 million tonnes, 10 million tonnes tops steel output. As I said, the US recycles most of it already. If they need a little bit of iron ore, it's not hard to get. Plenty of mines in Canada or Brazil just down the road. It's just not a big new marginal source of supply. So that probably brings us around again to copper and some of the other metals, that because there will be a pretty significant you know, energy transformation component to what Biden is doing. But yeah, so I might just throw over to you, Damo, and see how that might play out. Yeah,
so I just wanted to put copper, because that's the one everyone talks about as being this huge demand coming from electric vehicles. And you know, an internal combustion car uses about 20 kilos of copper. A battery EV is more like 50 to 60. And the idea behind that is, you know, it's more the motor side of that needs that extra, and just copper wiring sort of coiled to make the within the car.
Yep.
So I just want to put that in perspective, though. So a 2-bedroom apartment uses sort of 125 to 150 kilos, and a 3-bedroom house is sort of 200 to 250 kilos. So, you know, we spoke about. It's just as we spoke about the Chinese building cycle. The Chinese building cycle is just as important to the copper as the car side.
Yep.
Because the numbers are so much bigger.
Yep.
If you're building fewer apartments, then that's
You need to build a lot more cars.
Exactly. So let's say it's about 35. You need about 35 extra kilos in a battery car.
Yep. From a petrol.
From a petrol.
Yeah.
So if instead of building an internal combustion, you build a battery one, you're using 35 extra. So if you build one less apartment, you better be building 4 more cars.
Yeah.
Of those cars. So you build one less house, and it's 6 or 7 cars.
Yep.
So, and the broad numbers, so there's about 100 million cars a year, a little bit less than that, gets produced globally.
Mm-hmm.
And so if you sort of look at it from that perspective and said, okay, so we need 35 extra kilos by 100 million cars, and by, put that into tons. And so that means we need 3.5 million tons of extra demand. So that's if we went tomorrow. So if tomorrow we flipped and said, okay, no more petrol cars. Everyone's building electric cars.
Mm-hmm.
3.5 million tons. The global amount of copper is about 30 million tons a year, which is sort of made up of 20 million of mining and 10 of recycling.
Yep.
So it's about 12% more copper. So if you think
it's not a big bump, is it?
It's not a huge bump.
Yep.
If you think we're moving copper from, if you think we're going to move over, say, 6 to 12 years, you're talking 1 to 2% extra copper we're going to need per year for the next dozen years.
Yep.
Which is it's meaningful. It's not it's a good thing for prices and all that type of stuff. But it's not we're not talking about a different planet. We're not talking about doubling the amount of copper needed globally. You look back at the copper used for then electricity networks,
Mm-hmm.
and you do a similar type of calculation. And again, so you get sort of similar numbers in that you need about 5%. So you need a couple of percent extra electricity per year. Even less than that. If I'm talking about 6 to 12 years, it's less than 1% per year growth in electricity that you're going to need to sort of cater for that. But on the flip side, if you're getting a lot more centralized electricity in that people generating from their own house and storing it in a battery, then you actually need less copper because you don't need all that transmission stuff.
Of course.
And so there's swings and roundabouts on that side. So there's certainly more copper needed if you said, okay, we're going to be producing from big solar farms and big wind farms roughly in the same places or in new places, I suppose, and piping that back into networks and running these massive transmission lines. But if it's coming back to more batteries and more centralized, sort of localized power, then it possibly balances out a little bit. Yeah. So, there's certainly... I'm not sold on which way that's going. There's certainly some good arguments in both cases, but I guess where I'm coming to from this is there's not an immediate clear here's where this super cycle is going to come from. Where in terms of China, you saw that chart where they went from basically went from 10% of the world demand to over 50%.
Yep.
Like that was pretty much doubling of the world demand for those things. And that happened in copper, it happened in iron ore, a whole bunch of different commodities. It's not that same type of growth.
Yep.
You look at.
Okay. All right, very rational. Cost curves, do we want to jump into those?
Yeah, so I'll go relatively quickly on this. It's a little bit of, I suppose, probably getting too much into the stats part of it. But I just wanted to, the other side is saying, well, what goes into mining costs, and is there potential that you could that there's actually a lot of cost increases coming through on the mining, and so therefore because there's cost increases, therefore the commodity prices will have to go up.
Yep.
And so I've just got like a few different types of mining, and so basically some of the mining on the left there is this what you call open pit mining, and you basically have to clear away a certain amount of dirt that's sitting on top of the mine, then you've got to dig it all out. And then once you start getting too much dirt on top, then they go, we're not going to bother clearing the dirt because it's going to be too expensive. We actually just want to go straight underground, and you just go following this ore body. And there's for a few metals you can do that. On the far right, there's that in situ where you basically just send acid and other stuff down one end and then suck up the liquid up the other end, and so that avoids having to mine all that, but it's obviously at the cost of sticking some quite toxic chemicals into the ground. But that works for uranium, for example. That's a very common way of mining uranium. So so that's your sort of rough mining methods. And just to give you an idea of some of the costs that are going into that, so if you're doing an open pit, you basically it's about $1.50 to $2.50 to move a ton of dirt. And so the question is, how many tons do you need to move before you get down?
Mm-hmm.
And that is certainly an issue. Mines are getting what they call the strip ratios. They're getting larger over time, so you do have to move more. The flip side is there is a fair bit of automation going on, and the big iron ore mines. Rio is now running its trucks autonomously. It runs its trains autonomously. They're looking at other things they can do autonomously. And once you hit to an autonomous one, now you actually don't have to worry about your person cost, which is the other big cost, which is one of the big costs that go into that.
Yep.
And those costs sort of are going to keep coming down over time. So it's not as much in some of the other industries because in iron ore you're selling. Well, in long-term prices, you're selling at sort of $50, $60 a ton. And so if it's costing you $1.50 or $2.50 makes a big difference in terms of your profitability on it. With copper, you're selling thousands of dollars per ton, like you're $9,000 a ton at the moment. Yep. So really, that stuff doesn't make that much difference at the margin. It's more, So and then there's a few different. Then you start going underground, and your underground costs sort of start at 15 to 25 if you're doing like these massive big caving operations, which are sort of bulk mining underground. And then as you get smaller and smaller stoping, where you're sort of leaving empty bits behind, and your costs go up, but and at the bottom end you sort of got guys in there with jackhammers sort of trying to pull out stuff, and that only works for really high value stuff like say gold. It really doesn't get used much for the other ones. So your costs are with all these is basically your equipment, your consumables, whether it's drills and those types of things, and your labour sitting on this. So the labour is more and more being automated. And then your energy costs as well. So usually diesel. So that's a big one. So if oil price goes booming back over $100, that's going to make a difference to all these costs. The flip side is they are trying electric stuff and solar power generation, and they're actually saving money. A lot of miners, they were at the sort of the pointy end of the cost curve in terms of if you had to run diesel generators to run, say, your processing plants because you're in this really out of the way part. Now you can start using solar power, which is actually a lot cheaper than diesel generators, and save some costs on that front. So there's a little bit swings and roundabouts on that, but really there's nothing beyond an oil price spike to the hundreds of dollars. There's really nothing that's sort of massive change in those costs that you can see coming through, and chances are you're facing downward cost pressure.
Yep. Okay. Other costs?
Then you sort of go processing and transport. Transport makes a big difference to
bulk,
to the bulk commodities again. But again, we're talking about taking a ton by rail. 1,000 kilometres is $20, and that's a long way in rail. 1,000 kilometres. So makes a big difference if you're selling iron ore at $60, $70 a ton. If you're selling copper at $9,000 a ton, well, you're probably not on rail anyway. But it doesn't. The transport's basically meaningless for those ones. And then once you're on a ship, actually, it doesn't really matter how far once there's a bit of cost getting it on and off, but actually the distance hardly makes that much difference once you've put it on and off. And
not expected to change.
It's pretty minor. It's pretty minor part.
Unless you're stuck in a traffic jam in the
Suez Canal.
Suez Canal.
Exactly. So none of those costs are ones which you look at and say, structurally there's a big change coming to them.
Bit of inflation now just because of the COVID constraints and things. But
yes,
it's going to pass as we reopen.
Yes, and
that quickly.
Yeah, and that's the supply side, which is on this next one. Is just showing copper production sort of gradually growing over time, and 2020 production falling back, and a lot of that is just it's been COVID affected. So a lot of mines that just state government is just whatever putting them into lockdowns. Chile is the world's biggest producer of copper, and they're right at the front of the vaccines. They're up in the top 4 or 5 countries in terms of rollouts of vaccines.
Oh, right.
So you'd expect copper will be back on sooner rather than later.
Yep.
Brazil and Australia are the big iron ore producers. Australia has basically been pretty much unchanged throughout the period, so it's still booming. Brazil's been quite badly affected, and their rollout of vaccines is behind. So So from a supply perspective, Brazil's probably a little bit out of the
Out of the picture.
out of the picture for a little bit, but
Yeah, I mean, they had some supply problems from the pandemic, but they managed through it mostly. I don't expect another virus impact. Brazil just
no, it's probably more just a bounce. It's not like there's a big bounce back coming in Brazil. Like if they wanted to ramp up volumes, it'll be harder for them to do that in Brazil than say Chile, where most of the population vaccinated.
sure, yes. Nonetheless, I think they'll be normalising through this year. I mean, put it this way, for the first time since the Vale accident, the last 6 months or so, Vale's hit all of its targets for returning volumes, output, whereas before that it was failure and missing of deadlines and just the whole thing getting worse. So I think they've got a handle on it now. They seem to have passed the nadir of their problems.
Yep. The next question is, do we have enough, if we need to produce this, is there enough out there, enough copper out there? And that's this next chart just sort of showing, so it's a few years old, this one, but it's the trend is still the same. So what it's showing is global copper reserves versus production. And the green line's the reserves. And so while you sort of look back in 1950 and said, well, if we need to double the production, could we do it? And say, well, no, we're going to only last a few years. You can see that over time, as production's grown, the reserves have grown as well.
Just because we become better at finding it. Is that right? Or, okay.
They're finding more and more.
Exploration's getting better.
And the other thing is the cost, because so people they'll find a bunch of copper at, in the 1950s, you'd find a bunch of copper at 1%, and you'd say, I'm not going to class it as a reserve because I can't pull it out of the ground profitably. Now we can.
Yeah, sure.
And prices are a bit higher, and methods
Technology.
are better and all that type of stuff. And
Yep.
so now it is a reserve, something they found ages ago but didn't classify.
Yeah, okay.
And
All right, good point.
so rising prices automatically increases your reserves of just things that people have found that they haven't actually developed. And then existing mines that are, there's no, like BHP has got a massive one in Olympic Dam, with copper and uranium and a bit of gold and stuff like that in it, where they spoke in the mining boom, spoke about whether they're going to do this massive project to dig it all up. They know it's there, it's sitting there. They're just gradually digging down towards it.
Yep.
It's got years and years and years of life left, and if they need to ramp it up, they could ramp it up.
Yep.
If copper prices were high enough,
That's
would.
right. Yep.
Yeah.
Put on an extra shift and off you go.
I think that's sort of like 20 or 30 billion worth of capex spend, but it's a big cost. But it's we know the copper's there. It's not as if it's not as if there's you don't have the
it's
supply.
going to zero once you run out.
And obviously there was a whole argument with oil for a while, is maybe we will run out of oil, and especially some of the cheap oil, and then you found all the US shale, and that sort of went away. But there are some commodities where that's an issue. Most of the big ones, it's just not an issue.
Yep.
It's just that the stuff's there. It is a little bit of a matter of price, but it's more so that whole commodity cycle stuff we're talking about.
Okay, very good. We'll jump across to financial flows, and actually I think this is going to answer my question from earlier, but I might throw out to our audience as well to pop in any questions in the YouTube live chat as well, so we can get those answered before we finish up. So here we go, financial flows. So the question I posed before was real demand versus synthetic demand. Where are these? Where's Wall Street intervening and creating potentially a bit of a price bubble?
Well, you've said it right there. Wall Street's trying to blow a bubble. What they do best. It's about all they do. So
they're trying to front run the demand. Really, they're going, oh, this is going to be huge, so let's go out and buy it.
Yep.
And so
So there's a couple of kind of self feeding processes that go on in this. So you get this underlying thesis of supply shortage, which is the key to a super cycle. Right, a structural supply shortage. In this case, some are positing underinvestment in oil. Others are positing, the EV charge, transformation. Others are saying the infrastructure drive. These are all the thesis of an imbalance in the market that will last for years.
The grain of truth at the heart of the.
They are heart of the bullshit. Yeah. so that's triggered some speculative buying, some hoarding.
Mm-hmm.
That said, there's not a lot of evidence of a lot of hoarding yet. Like a lot of the copper stocks, for instance, have been quite low, although they're starting to rise now. The Chinese iron ore inventory cycle was actually reasonably low. It started to climb a bit. But it certainly has triggered some speculative buying. And then once you start to get this buying and you get the rising prices, then people start to worry about inflation as well. So you've got this very basic input into production with rising prices, and then Wall Street says, well, all these rising prices mean you need to hold hard assets. Right? So you've got to buy commodities.
Yeah, right. Yep.
So you can see how this cycle feeds on itself, right? And it's done so already, like incredibly aggressive over the last 6 months. This comes back to something that we've talked about before very frequently about this cycle, which is so unique about it, is that it's kind of on amphetamines. This is the disco biscuit business cycle, where because it was so heavily disrupted by COVID, it's just super accelerated. And so you've got all sorts of booms and busts that would take 10 years happening in one. And now we have the commodity demand bust. Yep. And then we've had heaps of stimulus and whatever, and then a huge good demand for goods, especially with everybody locked up at home, and so there's big commodity demands come back, and then we've had a few supply disruptions, and so price popped, and then you've had this wild kind of speculative buying coming in from Wall Street and this big spruik about a new super cycle. So with matched by a crazed fear of inflation, right? Now, so we've put 1 and 3 together there, and I'll just go back to 2 on the list, which is Chimerica and the US dollar. Usually what happens at the beginning of a business cycle, is you get easing coming out of the US after a shock. The Federal Reserve, slashes interest rates, and as the globe starts to recover, you see the US dollar getting debased. People start selling US dollars, basically. And so that gives you then another input into commodity inflation, right? Because they're all priced in US dollars. So a softer US dollar makes people think I better buy commodities because they'll go up in relative price terms. What's happened very unusually in this cycle is that we've been through all of these things, and normally this recovery process of a falling US dollar would last another probably 2 years into a new business cycle. Well, while the Fed stays incredibly easy, but there's a critical change in this cycle, and that is the entrance of fiscal in the US, particularly in the US, much bigger in the US than anywhere else, because the Dems have won. Power in Washington. Yep. They recognise that they need to drive a very strong economy, particularly at the low end, to get wage rises going, so that they can recapture their working class base from Donald Trump. Yep. And the key to that is lots of infrastructure spending. And so, as a result, here we are just 12 months on. The US had a terrible COVID experience, but because of all the fiscal stimulus, there's two things. First, it's one of the leaders of the vaccine rollout, so it's going to come flying out of that. And then it's got this terrific kind of fiscal tailwind that means US growth, inflation, and now yields are all leading the cycle. This would not normally be happening. And so it's kind of exceptionalism in US economic performance. Normally, in a typical cycle, like we did with the Chimerica unwind after the GFC, you would see.
Just to define that, that's the combination of China and America.
Yes,
so, and the whole idea was that Chinese supply was rising to meet American demand, and more American workers went offshore, and
So in effect, you had a weak US and a strong China. Now, we've had stimulus in China. It came out first, and it's tightening, and it's going to slow really fast. as we said, we've already gestured at or discussed, its structural problems are coming to bear, so it's forced to slow. And the US has had this great realisation that it needs to spend fiscally, and so it's going to lead the cycle. This is a complete opposite of what you would normally get, or we've had over the last couple of cycles. Basically, the dot-com bust and then the GFC bust, where you would get, a weak US driving a weak US dollar, driving commodity demand, and like mobilising labour in China with heaps of production. So you had basically financial and fundamental drivers for commodities.
Yep.
So we've had like 3 or 4 months of this, or 6 months, but the US dollar is now turning and getting stronger because the US is about to lead the cycle, not China.
Okay.
And so the US dollar starts to rise, and that reverses everything about commodities and commodity demand. So in financial terms, if the US dollar is rising, then the relative price of commodities is falling. If the US dollar is rising, then global inflation is going to start to fall because it sucks money out of all sorts of emerging markets and commodities and various other impacts. And so the financial flow setup for this cycle, which looked super cycle for a few months, is very quickly going into reverse. And so there's absolutely, I would argue, no reason to hoard commodities at this point. Even though Wall Street is almost wall-to-wall telling everyone to buy them, I think you'll find in a few months it all reverses.
They're just trying to get out.
Well,
talk their book up.
We might see it. Let's say we might see a few more bullish notes before they all capitulate.
Yeah, right. Okay. Interesting.
So the financial flows have been supportive, but they're not going to be supportive in my view. Now, the one risk factor in that is that if that rising US dollar starts to actually damage global reflation, then the Fed might be forced to come in and do more easing, which would give you another leg in commodities.
Yep.
Because it'd kick the US dollar as hard as it could, and then you'd get a little bit more of a pop. That's quite possible, but I think that's a risk case, not the base case. The base case, I think, is that because there's so much fiscal spending in the US and a little bit in Europe, the economy will stay strong despite some of the deflationary impacts of the US dollar. And so the Fed won't need to come in, but it is possible.
Okay.
Yeah.
Very good. All right, no problems. Should we jump across to the investment implications? Here we go.
Yeah, I actually just want to talk a little bit around just this whole idea of what David was talking about, the disco biscuit investment cycle.
Yeah.
So it's
the Enfeta cycle.
Enfeta cycle, yeah. And what it means is that we started polling to value stocks pre-Christmas and loading up on that and I still think there's a little bit left to run, but not in every sector. So it's at the stage where ordinarily that'd be like a year, or as David said, a year or 2 years worth of here's our investment strategy, and we'll just sort of keep up with that.
Got to be a bit more nimble this time.
Prices have moved, prices have moved and are moving, and so there's stocks and sectors that we were happy to buy a few months ago. Commodities is one of them, where we were happy to own some iron ore and relatively big exposure in some of those, but we're rolling out of those just because the price action has been so quick. And so it's it's not as it's moving a hell of a lot faster than it used to.
Yep.
And there's a lot going on. There's still some room left in the value trade, but you need to be a lot more selective about where you're picking up that than say 3 or 4 months ago. And in particular this month, we've very much seen the value trade take off.
Yep. So what's next? The death of value?
I'll just add the key driver there is inflation. So if you think inflation is going to continue on a more bullish path than the last cycle, where we had secular stagnation, then you would stay long that, and probably commodities as well. And we're certainly heading into an inflation pop on base effects and other things which we've discussed at length in other poddies. But we think that the structural deflationary forces are still intact. And so once we get through that over the next 6 months, 3 to 6 months, then it'll be back to less inflation. Maybe not as low as the last cycle, but low enough.
Okay.
And so that starts to, as Damo says, that's already going to start to give you a cap on your value rotation trade.
Okay.
Because it's driven by rising yields.
Yep. Okay. And we've seen plenty of those in the last sort of month or so.
We have. And we think there's more to come.
Yep.
Because there's more inflation coming and there's more talk around US fiscal. Plus there's the big reopening of the global economy with the vaccines. And so there's plenty of, if you're a crazed inflationista, you're going to have some stuff to run with for a while.
Yep. Okay. All right. Very good. Anything else on the in the investment outlook in reference to today's
I'll
topic?
leave it at that because we've spoken a lot about these, and I'm sure we will again.
Yep. No problems at all. All right. Well, look, thank you, gentlemen. We'll jump across to our question of the day, which is: how long do you think that this super cycle might last? Feel free to drop in your questions or your answers to that question, rather, in the YouTube chat box, and we always enjoy running through our viewers' feedback and hearing a bit more, or your take, I guess, on the topic of the day as well. We thank you to all those who have watched in live for another great episode, and to all those who have watched in post, of course, as well. We hope you've taken away some great ideas, and if you haven't already, feel free to click like on the video to give us some feedback. If you'd like to see more of our content, head over to nucleuswealth.com/content. To stay up to date on news from us, follow us on social media. And finally, if you know anyone who'd get something out of today's episode, let them know about it, share with a friend, and help our show grow. So thanks again for tuning in from myself, Tim Fuller, and the team. And we look forward to catching you at the next one. Cheers.